What are we to make of gold's recent fall below $2,850 an ounce? Well, I'm not concerned. Gold needs a little time to consolidate above $2,800 before making an assault on $3,000 an ounce. That has been the pattern over the last year or so. First it was $2,000, then $2,300, then $2,600, now $2,800. Each time the market rallied, then consolidated, then rallied again to new highs. I've advised clients to buy the dip. That is, to use price declines as an opportunity to increase your gold allocations. This is the time to buy. U.S. gold buyers often buy when prices are rising in fear of missing out on a rally. But often the smarter move is to watch for short-term price reductions in a rising market, and then make your move. But how do you know whether a price decline is short-term or marks a sustained price reversal? It helps to understand the underlying forces driving the price of an asset and whether those forces support a rally or have shifted to erode one. I've talked a lot about the forces that are driving the current 17-month rally, forces that I believe will be sustained over the long term. Strong central bank demand, geopolitical conflict, political instability in the U.S. and Europe, economic uncertainty in China and the U.S., the strength or weakness of the dollar, worldwide private and government debt burdens, especially in China and the U.S., and the apparent inability of miners to increase production. Taken together, these forces are aligned to drive prices upward for the foreseeable future. Analysts around the globe tend to agree. Only 2 months into the year, they are already raising their year-end forecasts. Many now see gold breaking $3,000 an ounce, a gain of almost $400 this year. Other analysts are more optimistic. For example, on February 28th, Goldman Sachs raised its year-end target to $3,100, but also described a scenario that would take gold to $3,300 this year. My forecast has been even more aggressive, targeting $3,500 by December 31st. That comes to a whopping $900 increase for the year, leaving 2024's historic rally in the dust. Why do I feel justified in being so optimistic about gold prices? Government debt burdens. A lot of attention is given to U.S. government debt, but it's not just our debt. It's China's massive debt too. And soon Europe will be rapidly increasing its debt burden to fund a more assertive defense posture against Russia and to stimulate its weak economies. This global tidal surge of debt will drive interest rates higher and amplify central bank rate hikes to tame resurgent inflation. But the most immediate threat to us lies in the U.S., where the House of Representatives has passed a budget that would increase the debt by $6 trillion over the next 10 years, putting it in excess of $43 trillion. And even $43 trillion is improbably low. It assumes that no wars, economic or financial crises, pandemics, or politically popular tax ideas lead Congress to increase spending or reduce income sometime in the next 10 years. What are the odds of that? I recall that when I entered the Treasury Department in 1993, the debt stood at $4.4 trillion. Which means that over the course of the nation's entire 204-year history up to that point, through civil and world wars, depressions, and pandemics, the nation had accumulated less debt than we would add in a decade under this budget. And when I left the Mint 8 years later, the debt was only $1.2 trillion higher, and we were reducing it with annual budget surpluses. While this current budget has been adopted by the U.S. House, the Senate still needs to act. But if it greenlights a similar sized deficit, which I expect, the consequences for the nation's economy could be dire. And since the exceptionally strong U.S. economy is sustaining an otherwise marginal world economy, the fallout would be global. As I've highlighted to you before, private and central bank demand in China and India are by far the world's biggest gold markets. Economic, political, and geopolitical instability affecting those markets is likely to drive demand well above other analysts' forecasts, which is why my expectations for gold are so much higher. So keep an eye on what Congress does with the budget and how skyrocketing debt affects the global economy. And buy the dip.